In the next session, I want to further explore the application of Section 42 to some reasonably complex transactions. And I make no apology for dwelling for so long on Section 42. We'll get to the other provisions in due course, and we will give them due time. We have a problem for analysis, and it might be useful if you close your books here so you can participate in the pursuit of an answer rather than just flicking to the next slide. You may have a different and a better answer to whatever I might have suggested to you. Okay? We have two companies, ACO and BCO. They are coincidentally worth exactly 100 million rand each. Yeah? You've been asked to advise on the manner in which BCO may be repositioned as a wholly owned subsidiary of ACO, preferably without any capital gains tax exposures. If you look at your diagram, you'll see that there is an initial obstacle to positioning BCO as a subsidiary of ACO. BCO has a 30% shareholding in ACO. The Companies Act says that a subsidiary may not have a more than 10% shareholding in its holding company by way of so-called treasury shares. Okay? Treasury shares because they denied any voting rights. Okay? How do we overcome this obstacle? We cannot position BCO as a subsidiary of ACO for as long as BCO has that 30% shareholding in ACO. How do we get this obstacle out of the way without any tax complications? What do? We have ACO do something. What is that something? I smell grey cells burning. Yeah? I don't see any hands going up. Yes?
I said BCO should
ACO should?
shares in ACO.
Sorry?
BCO gives ACO its shares, in return for which it obtains shares in ACO.
Simpler answer. ACO affects a buyback of the shares held in ACO, the 30% shareholding held in ACO by BCO. Now, what is your tax analysis in the event of a share buyback? Yes, dividend. The excess of the buyback amount per share over the issue price of the shares will, for tax purposes, be a dividend. Yeah? Now, if the excess of the buyback price of this 30% parcel of shares over the issue price of each share, yeah, is a dividend, does this have any tax consequences? No, because again, under the current dividend regime, a dividend in favor of a fellow South African resident company is free of dividend tax. Okay, now we can begin to play. Yeah? The obstacle has been removed. And looking to liquidity requirements at the level of ACO, we would have affected the buyback on loan account. Okay? Cash doesn't have to flow immediately. But let's look again at the composition of the shareholders in these companies. We've got Anne with 24% in BCO, Tom with nothing, 6% in ACO, Dick and Harry each 3% in BCO, then there are Cedric and Anton with 40% and 30% in BCO. Can all of these parties qualify for a share-for-share exchange under Section 42? Because what we are contemplating doing is having Anne, Tom, Dick, Harry, Cedric and Anton, each of them selling or transferring their shares in BCO to ACO, in satisfaction of which ACO will issue shares in itself to the former BCO shareholders. Section 42, share for share exchange. Is everybody going to qualify for relief? No? Why not? Okay. Whether everybody qualifies turns on the answer to a question. The question is whether your small minority shareholders, Dick and Harry, are going to be full-time employees of either ACO or BCO subsequent to the share for share exchange. When you in a private company see a small minority shareholding such as 3%, what does it typically represent? A share held by some member of management, a full-time employee's share. Okay. So these small minority shareholdings will not be an obstacle to everybody qualifying under Section 42 when you then effect your share for share exchange. I presented you with this example because I was sometime in the course of last year presented with a beautifully written analysis by a firm of accountants. I won't identify them, which explained that Dick and Harry couldn't possibly qualify because they come to hold less than 10%. So there were also other small minority shareholders. And then went on to say, but hey, there was an answer to this. These small minority shareholders, as a preparatory move, should first transfer their shares to their own company, and their own, in which they would each have more than 10%. And their own company must then take up, transfer its shares in BCO to ACO, in which it would also have at least 10%. All of that entirely unnecessary. It was an earnest opinion, drafted and crafted, in pursuit of a solution to a problem that wasn't there. Again, if you see small minority shareholdings in a private company, they are generally indicative of a full-time employment relationship. Let's look at another analysis. And again, what I'm setting out to do is to put these corporate rules in a commercial context for you. Because it's only when one puts them in a commercial context that you begin to understand what they mean as opposed to what they merely say. Let's look at the next analysis. The slide again just reiterates my running commentary on Tom and Dick, and was it Tom and Harry? Was there a Dick too? I'm not sure. You can linger over it for a moment, but I want to advance to the next problem. Here's our next problem for analysis. This is a tale about butchers. A, B, C, D, and F, and so on. They all represent partnerships in the wholesale meat trade. And you'll see there's some overlapping membership. A, for example, is a partner in the ABC partnership, also in the ADF partnership and the BAF partnership. Now, some merchant bank has persuaded these butchers that if they were to combine all these butchery assets, in a corporate vehicle, then they would have something which was ripe and ready for listing. And in order to gather all these assets under the umbrella of one or more companies, The merchant bank advised that what the various partners, A through to H, were to do is they would, one and all, transfer their various interests in partnership assets, yeah, to a company, call it Holdco, against an issue of shares, and this transaction should then qualify for rollover relief. Question whether it would. Question whether it would, because when you look at the wide number of members, considerable number of members, yeah, some of them, yeah, predictably would come to hold a less than 10% interest on the initial rollover. Okay? The merchant bank further recommended that following on the initial Section 42 rollover, the recipient company Holdco was itself to engage in a series of Section 42 transactions. What was envisaged is that the assets of each of the former partnerships, yeah, would be transferred in each case to a dedicated subsidiary. So the assets of the ABC partnership would be transferred by Holdco under Section 42 against an issue of shares to ABC Proprietary Limited, and so on. And then A, B, and C, the three partners in that partnership, were collectively to take up a 40% shareholding in ABC, and so on in respect of all the other dedicated subsidiaries. There was a commercial reason for doing this. Yeah? What they wanted to ensure is that each of the partners would, to a significant extent, 40%, derive their dividends only from that subsidiary in which they were deployed. Yeah? As to the balance of group profits, yeah, they would participate pro rata at Holdco level, yeah, collectively as to 60% of group profits. But they wanted this direct 40% linkage to the profits of that subsidiary in which the partners were themselves engaged. Yeah? Now tell me, when you complete the transfer of these assets to these subsidiaries, and A, B, and C are appointed as full-time employees of A, B, and C, and DEF are now full-time employees of DEF, would you qualify still for Section 42 rollover relief? You don't? Yeah. They will not be employees of controlled group companies in relation to Holdco. You need a minimum 70% linkage. Okay. All right. Now, the alternative might have been, I suppose, and this is perhaps artificial, I would balk at doing this, appointing them as full-time employees only of Holdco, yeah? And then seconding their services to these dedicated subsidiaries. Yeah? Okay? Be one way of doing it. But it's, there's an element of artifice in that which I'm uncomfortable with. And there is in any event an alternative approach which may be commercially more appealing. Okay? Let's look at that alternative approach. What you might contemplate doing in the alternative is not to have a string of subsidiaries, which are in any event costly to administer, but to have one divisionalized company in which you have, for example, the ABC division, which conducts that business previously conducted by the ABC partnership, yeah? And the DEF division conducting the business of the former DEF partnership, and so on. You then, in order to meet the parties' commercial objective, in order to achieve this linkage between dividend participation and that division in which you're actively involved, you issue two classes of shares. You issue an ordinary class of shares, which gives collective participation in 60% of the consolidated profits of all these divisions. You issue another and special class of shares, under which your dividend entitlement is linked to the profits of that division in which you employ. Yeah? So you might have the ABC special shares, yeah? which give the holders of those shares a collective entitlement to 40% of the profits of the ABC division. Now you've got a flat structure, you've got one divisionalized company. Cheaper to run, easy enough to determine divisional profits by reference to properly constructed management accounts. Yeah? All right? One disadvantage of this approach is that if there is a loss in any division, yeah, it's going to impact on overall profitability. Yeah? It may bring the whole structure down. Whereas if you have dedicated subsidiaries, you insulate yourself against the risk of any one subsidiary going down the tube. An advantage, however, is that the losses of any division for tax purposes can be set off against the profits of other divisions. A loss in a subsidiary cannot be set off against the profits of another subsidiary. Yeah? Overall, I prefer this flat divisionalized structure. Yeah?